Okay, welcome back to Outsourced Alpha. Excited that you spending some time with us here today. And look, quick housekeeping before I get into it and introduce today's guest. Nothing you hear today should be misconstrued as legal advice, investment advice, or any formal advice at all. I wouldn't take advice from me at all. So there's your disclaimer up front. And if you're new to the show, Outsourced Alpha is a show about the people and the dynamics that move capital in private markets, specific to professional services and technology providers. Today's conversation is no exception, and this gentleman across from me has an unusually honest vantage point on the fundraise. So Brian Banks spent the better part of his career as an LP, sitting on LPACs, running co-investments, doing the things that GPs are trying to convince someone else to do most of the time. And then he ended up at Kirkland, a preeminent law firm advising GPs on the other side of the table. So to me, he's a one-of-one, somebody I'm fortunate enough to call a friend. And before we get into his introduction, I want to set just a little bit of precedent. So we at Juniper Square sit uniquely between thousands of GPs and the LPs writing checks into them. And what's clearest from my seat anyway is how much of that GP-LP relationship can run on inference and questions as opposed to some sort of pre-scripted advice. And so you have a lot of game theory. And Brian's one of the few people who have lived both sides of that very cleanly. And that's a really good lens for today's conversation. So with that said, Brian, why don't you tell us a little bit about yourself, your role at Kirkland, and how you got here to be in strategy and client development, which is, as I understand, not a lawyer, but you're working at a preeminent law firm.
Yeah, no, thanks, Derek. And thanks for having me. This is a conversation I'm really looking forward to having. My background, as you mentioned, is very unique, and I appreciated your disclaimer earlier. And again, despite having the logo Kirkland Ellis on my top and having been at Kirkland now for 9 years, let me reemphasize the fact that I am not a lawyer. I never give legal advice, and I am positioned, as you said, to provide our clients with a different perspective from the 700 attorneys in my fund formation practice at Kirkland Ellis. My background is very unique. Since about 2000, we could go earlier than 2000, but I don't know that we need to start when I was just out of college back in 1991. But what I will say is from 91 to 2000, I spent years as an investment banker, as a management consultant, got an MBA, all of which provided me broad experience within investments, broad experience in interacting with senior professionals across different industries, and gave me confidence to speak confidently, to get up to speed quickly. Fast forward to late 99, I was consulting up in Seattle for Ernst & Young. Teams were literally evaporating as we were on engagements with the dot-com boom. People were leaving in Seattle to go to companies like Amazon, coming down to the Bay Area to join, you name the startup. And I was fortunate to have had a long-standing family friend who ran an investment company based out of London. And he had been investing in North America in venture before it was known as venture, and buyout before it was actually known as buyout, since the 70s. And he had tried to recruit me out of undergraduate, tried to recruit me before going to business school, then tried to recruit me after business school. And finally in late 99, as I was also getting approached by dot-coms and other startups around the Bay Area and Seattle, where I was living at the time, he said, look, 99% of those businesses are going to go bankrupt before you even can try to realize anything. Come join my firm. I trust you. I think you'd be a really good proponent of my strategy. So I joined him in late 99, early 2000 to manage his US portfolio of venture and buyout investments. Based in San Francisco, overseeing at the time a pool of about 15 to 18 commitments into venture capital firms as well as buyout firms. And again, going back to 2000, we were investing in GPs that had $75 million on the cover, $100 million on the cover. It's interesting when we look at the size and the scope of GPs today. 1984 was the first time there was a fund that was over $1 billion, but it was only until 2015 that more than 10 funds closed over $1 billion. So again, billion dollar funds were outliers. I was managing relationships with funds, again, ranging from, 75 million of AUM up to 250, 300, 500. I stayed with this firm for about 11 years and did everything as you indicated that an LP does. I dug deep from a diligence perspective into evaluating GPs. I rationalized what was a very piecemeal portfolio. I sold things in the secondary market before the secondary market was an actual industry. I identified, diligence, and executed co-investments. And at the time, it was actually a very active co-investment strategy. Sat on boards, participated in diligence, went to the board meetings, et cetera, and really had a seat at the table as opposed to a passive co-investor. And again, over the 11 years, represented this firm in North America, added new GPs into the portfolio, exited some through the secondary market. And, as a lot of people see who've spent time on the family office / private investment side, strategies change on a pretty frequent basis. I've referenced family office. This was a very tightly held, publicly traded institution. So it was essentially running from one family, and there were some changes at the top. Felt like it was time for me to move on. I moved from there to an RIA, where I spent about 4.5 years running all private capital, ultimately at about a $10 billion AUA RIA. That was a fantastic experience. It showed me a different side of the table, again, working within the multifamily wealth channel, which is now, fast forward, very relevant to what we see in the market today. So I was investing and managing what are now known as a series of interval funds. So we had a multi-tiered approach, some investments in public, highly liquid assets, some intermediate hedge fund type strategies. And then ultimately, the vast majority of these investments were in private equity or private type vehicles. So, again, and we can talk about this later, very relevant to clients today. 4 years there, 4.5 years there, time to move on for a variety of reasons. After a few months of independent consulting, ended up at a placement agent. And the placement agent asked me to come in and lead origination. So that's business development for the placement agent. Going out, identifying GPs, trying to convince them that we were the right fit for them. That placement agent decided after about 18 months of my being there that they wanted to close the San Francisco office, where I'd been professionally since 2000. And moving from San Francisco wasn't something I wanted to do. During my 18 months, I got to know a few individuals at Kirkland Ellis in a both legal capacity as well as in a business development capacity. When they heard that I was available as a result of them closing this office, one of those individuals called me and said, "Hey, we have a very nebulous role. We'd love for you to come in and consider it." And, I said immediately, "Okay, give me the job description, or can you send the job spec?" And he said, "No, the job spec is help clients however you can. Use your background and help however you can." I said, "Is there a title?" "No, everyone here is either a lawyer or a staff." So we came up with this very nebulous strategy and client relations role. Had a couple of conversations, met the local office here in Seattle and San Francisco. They flew me to New York, and given the size and the position of Kirkland, it was really interesting. I had a 2-hour meeting with the senior partner of the investment funds group, whose office was literally the office they used in Law and Order. And I was like, wow, this is really a pretty impressive organization. So fast forward 9 years. I've been there now 9 years. And again, joining was an interesting scenario because I generally had been someone who liked structure. I liked having a job description. I liked having deliverables. I was a consultant in the past, and everything in consulting is deliverable focused. This job description, help clients however you can. I didn't know what my role would be. I didn't know how well I'd be accepted within Kirkland, but literally day one, I started receiving inbound emails and calls from senior partners around the world, introducing clients to me on an unchaperoned basis. "Hey, this is Derek. He runs a $15 billion GP. They're thinking about raising their new fund, but they haven't updated their materials, or they need to think about a placement agent, or they're looking to expand overseas. Can you talk to them?" And again, this cadence started on a very regular basis. So over the last 9 years, I've built this practice, this role where I probably spend about 50% of my time working with emerging managers of all sizes. As a firm, Kirkland really focuses on 250, 300 million AU fund size and above. But I'll talk to anyone. Again, I don't bill for my time, which is incredibly unique within the legal community. So for those of you who are familiar with Wall Street hedge funds, investment banking, it's almost a cap intros role. The idea is to just spend time, demonstrate value, be a resource, be a thought partner with entrepreneurs, with general partners. And maybe at some point they'll come back and hire Kirkland. But that said, about half my time with emerging managers, I'm often the first set of external eyeballs to look at a marketing deck, to read the commercial language of a PPM. I advise on how to better narrow the story, how to better articulate the strategy, how to think through go to market, go to fundraise. I make introductions to other service providers. One of the things that I try to do is stay current with the majority of relevant service providers, from software to recruiters to fund administrators to software providers to placement agents. One thing I don't do, and we try not to ever do, is make direct introductions to limited partners. That's obviously the universe of the placement agent. We have at Kirkland at any given time over 1,000 GP clients who are fundraising. So it would be virtually impossible to pick and choose and be selective who I could make those phone calls for. So we've decided that we're not going to do it at all. 50% of my time, like I said, emerging managers, being a shoulder to cry on, give them advice throughout the process. Sometimes I tell people not to go out and fundraise, tell them to do independent deals and not actually try to raise a closed-ended fund. The other 50% of my time is with established managers. So I will work with a very large manager in some situations, as well as, the funds 3 and 4 that are, raising $1 billion for the first time. And again, help them with marketing, with investor relations, with LPAC issues, with new strategic relationships across the service provider community. Often it could be related to launching a new product or a new strategy. Certain situations I might get involved in and advise a client to think about a continuation vehicle or another secondary strategy. Again, the beauty of this role is it's a very nebulous one. No 2 days are the same. I get to interact with very senior people generally. I get to interact with people who are very enthusiastic about what they're doing. And in some cases, I get to interact with people who don't understand why things aren't progressing faster. And in many ways, I get to be a problem solver. It's fun for me giving advice to a client and then having them disappear and then reading about their close or reading about subsequent closes. Last week, I saw an announcement of a Fund 4 that was closing, and I worked with them as a Fund 2. Their first institutional fundraise. I introduced them to the placement agent. I took their marketing deck from 75 pages down to 20 pages, made the introductions, helped coach them. And, now they're managing $8 billion across 4 funds. And, I said 50% emerging, 50% existing. My other 50% is indirect business development. So I go to a lot of conferences to stay current, to support my clients, to meet new GPs, to stay, active with other service providers. So, as a result of those activities, I see and hear about a lot of emerging GPs, a lot of GPs that might need different legal help. And I'm constantly thinking about how I can assist Kirkland and how I can bring in new clients and help people who need help. Some of them don't know that they need the help. Some of them, may have worked with other law firms that were very good at that stage of their evolution. But now that they're larger, going international, have different tax issues, different regulatory issues, different software issues, I can be a sounding board. Very long answer, Derek, to a very short question. I apologize.
No, your experience is super unique. So we want to hear all of it. And I'm wondering who has more frequent flyer points, you or I. I see you at every conference I go to. And you do more European travel, though, so you might have the advantage. Look, I think one of the things you said was interesting. You have 1,000 GPs that are raising at any given time, which is absolutely nuts. You're seeing a lot of this in real time. And you mentioned maybe half of them are emerging, half of them are established. what are some of the characteristics of a successful emerging fund where you say, go forth and raise because you're going to have a good time in the market versus when do you actually advise them to hit pause? Is there any common theme or trend, or is this more intuition on your side?
Great question. I mean, there's a bit of intuition and obviously a bit of uh, just experience having had so many conversations. But every day, every quarter, I'm surprised, frankly, by groups that from one perspective, I wouldn't think would be successful raising a fund one. And then, the next thing you know, they've gotten great momentum and moved forward and had a close. And in fact, one of those groups I remember is one of the most successful first time funds ever that has since raised, I think they're on fund three or fund four. They've executed one of the largest CVs in history and are truly one of the leaders in the industry. And I remember having the first meeting with some of my colleagues saying, these guys are crazy the way they're thinking about it. But back to the question, I think one of the most important common themes from a success perspective is continuity of team. I think that it's really hard for an LP. And again, most of what I advise clients on is based on having been an LP, constantly talking to LPs and really understanding the LP perspective. And it's hard for an LP, particularly the gatekeeper at an LP entity, to recommend internally someone that doesn't check a lot of the boxes. One of the most important boxes is team and team continuity, having worked together, knowing each other. If there are 3 or 4 individuals that are able to spin out from an entity together, they've worked together for 4 or 5 years or hopefully more. That is, a key ingredient, in my opinion, to a successful fundraise as a first-time manager. Another key ingredient is focus, being targeted, being a niche strategy. I remember when I was on the LP side, a real estate fund came and pitched me. They had only invested over 20 years around a 2 square block radius of real estate in Manhattan. That was all they looked at. And they literally knew every building, every owner, every landlord, everything. And again, that is as niche as you can get, right? So if you're a GP coming out from a large entity and you can say that you were the guy who led a certain strategy within that larger GP and you're bringing 3 or 4 of your colleagues with you, that's another great indicator of potential success. Again, those are rare because the parent GP, for lack of a better term, is generally not that supportive of an entire team upping and leaving. It happens. There have been a few over the last 4 or 5 years that I can think of. It could be, something as simple as a strategy shift, right? Big parent GP decides they're not doing carbon-based investing anymore. So that, oil and gas team is going to spin out, or there's a succession change at the top and, they're just not going in a certain direction. But, speaking of going in certain directions, let me get back to focus of your question. So team continuity, niche, I think, being realistic from a sizing perspective is important, not only from the standpoint of finding appropriate deals that match what you think you can fundraise, but also messaging to the market. You don't want to try to pitch an LP and say that you're raising a huge amount of capital because you lose credibility. Unless you're really able to demonstrate that you've got an anchor, that you've got the backing, that you've done deals of that size, that you've got a network. It's really important not to scare away LPs before they start. Indirectly, I just mentioned another key, which is hopefully having an anchor, having relationships that will get you grounded and get you off the ground before, you really start that broader fundraising process.
Yeah. And what I noticed across your explanation and your answer is that there are successful sharpshooter niche emerging managers. There are brand names that almost by default get allocations every time they go to the market, and we all know who they are. Then, from our vantage point, and something Brandon Sedloff, my good colleague, talks about quite a bit, is this messy middle, this bifurcation. So on one hand, you have this recognized brand with a clean track record, but the path is hard, but is legible. And then you have emerging managers with good performance and less name recognition. I think what we're seeing now in the middle is that the mega funds are getting the institutional allocations. The emerging managers can carve a niche and find the believers, but there's a squeeze in the middle of that. So do you think it's overstated that the messy middle is getting pushed out of the market? Is this structural? Is this cyclical? Any commentary you have on those that are in that, fund 2 to fund 5 ballpark that are just having a tough time right now?
Yeah, I mean, everything you read and everything we're seeing is accurate with regards to what you just said. I mean, I think that messy middle is going to be messy. It's a very barbelled story right now where, the megas are, I think, raising between 50 to 70% of the total capital. Funds are getting larger. We're seeing, more 15 to $20 billion funds getting raised. On the lower emerging side, on the smaller end, again, it's the niche targeted scenarios that are getting done. Again, not many of them, but the good stories like, we just discussed, the ones that are attractive, that are appealing, that, the LP can check the box. Again, from a psychological perspective, from the LP side, it makes sense, right? So if you're the director of private equity at an institution, at an endowment, a foundation, a state, it's always easier to say yes than to say no. It's always easier to re-up in an existing manager than to not, because again, you're opening a bit of a can of worms by saying no, by saying, after having had a, 10-year, 12-year relationship with Brian Bank GP, we're now saying no, which raises the question, why? What's wrong with the existing portfolio? So again, re-upping is easier from the day-to-day perspective. On the lower end, there's FOMO, right? Fear of missing out. And you don't want to be that allocator who doesn't see and commit to the next great thing. And, these things, these new emerging managers take on a life of their own. And I advise my clients to create this sense of scarcity and create this perception when you're fundraising that you're going to miss out. And if you don't, come in early, come in at a certain level, this is your shot. This is your shot to establish the relationship. And of course, a lot of that is perception. A lot of that is, as my negotiations teacher in grad school said, it's strategic misrepresentation. You really want to create this mindset in the market that these are the guys. But, back to your question. Yeah, I mean, I think the middle is tough. I think that, I recently read that almost 80% of funds raised are established firms. So funds 3, 4, and above are representing about 80% of the funds that close. So again, that leaves a very small slice for the funds 2 and below. And again, what we're seeing, and we can talk about this maybe a little bit later, is a shift in LP perspectives and a shift in LP strategy. They're now much more focused on operational due diligence. They're now much more focused on the types of value creation through operational improvement as opposed to multiples, as opposed to revenue growth. And, it's harder for an undifferentiated GP to stand out. And, again, we'll probably talk about this a little bit further on, but differentiation, standing out are probably the most important themes for any manager, whether you're a first-time manager, whether it's, Derek and Brian GP trying to launch for the first time, or Derek and Brian raising Fund 12.
I like the idea of the Fund 12, if you want to just pick up on that and skip the hard part. Look,
Right.
I think we can stay on that for a minute because differentiation is a big component, whether you are in the emerging fund cohort, whether you sit in the messy middle, and performance might look identical from one manager to the next. So I guess one question I have, when you think about the emerging managers, and look, we work with a lot of successful emerging managers. We share clients with you, probably some of the same. When you think about securing that first institutional LP, how does an emerging manager stand out? What is the process getting from the initial outreach to securing an institutional allocation in a fund 1? Wonder if you have any comments on that.
Persistence. I mean, I think persistence is key. I think, there's one of the mistakes that I think a lot of GPs make is trying to push their strategy and their perceptions and their, you know, beliefs on an LP and convince the LP that they are correct. I think the better ones think of it more in a partnership perspective, understanding what that LP is looking for, understanding where there might be gaps, understanding what has, potentially blown up in the past for that particular LP or that institution. So, it's a very important piece of the fundraising puzzle, especially for emerging managers, developing that relationship and constantly having a back and forth and understanding how you can be helpful, understanding where there are gaps, understanding why that LP is the right LP for you as a GP and why you are the right GP for that LP. I mean, it could be something as simple as, active co-investment. It could be a geographic thing. It could be a historical transactions. It could be where the money came from. Again, for a family office or some of these, private foundations, could be from an entrepreneur, a very successful entrepreneur who could bring in certain things. You're right, where you mentioned earlier that, returns aren't necessarily as important as they once were because that delta is so narrow now. The return profile across the industry is very tight, particularly for on a quartile by quartile basis. So, getting in front of the right LP prospects, being a good person, being someone you want to spend time with. This is at the end of the day, a relationship driven business. And remembering that throughout the life cycle of the general partnership is critical. I mean, I've seen probably dozens of GPs that have kind of lost that perspective, right? As they're having succession, as they're having growth, as they're having increased numbers of LPs, they forget about where their, real anchors were, where that original money came from and who the people were in those seats. And, it's really critical to understand from a GP's perspective that, seats change. And, it could be the same LP in multiple funds, but it's not the same person. And that permeates everything that you should do as a GP, from visiting to spending time with them at their annual meeting, to thinking about them from an LPAC perspective, to things as simple as introducing yourself and introducing your colleagues. You could have been the decision maker on a commitment to a GP. I take it over and I have no idea who the GP is. And, they have the assumption, Brian and Derek are, fully up to speed on my portfolio and fully up to speed on everything. And the reality is they don't. The other piece is that, the smaller the GP team, the broader the individual's responsibility is, and the more strategies that they're responsible for overseeing. So, again, I hate to use a metaphor, an overused metaphor, but, you could be a mile wide and an inch deep. And again, as a result, you don't know what you don't know 90% of what the GP is talking about. And the GPs come in very focused, very esoteric strategies. They might have acronyms left and right. They might have maps and charts and graphs and everything. You never want to put an LP on the defensive. You never want them to not understand what you're telling them. So dummy everything down, take it down to as low as you can. And an LP will come back and say, I get it. Let's dig deeper. Let's double click on this. Let's go into the detail. But what you don't want to have happen is it just fly over someone's head. And again, you also don't want it to fly over their head because it's a game of telephone. They are the ones who are then sharing your story with their colleagues. What they don't want to do is not be able to articulate your strategy, be able to tell 2 or 3 case studies or stories. And secondly, look like dummies internally. I always joke that, the 2 primary goals for your average LP is not looking like a dummy internally and finding their next job. And so you as a GP are incentivized to make them look good. And, 15 years ago, it was as simple as sending documents in a cut and pastable format. So they could include your language in their IC memo. Today, it's obviously a little bit more robust and more involved in that. But again, it's coming in, being personable, telling stories, not being defensive, anticipating questions, reacting, being honest, not having skeletons in your closet. I mean, it's amazing how people still think that they can get, you know, have their history hidden. I once had a GP that, what's the word I'm trying to think of? I once had a GP that tried to blame a deal that went sideways on a dead guy, literally. And their deal attribution, that was the word I couldn't come up with. The deal attribution on a deal that became a total zero was cited in the footnote to a partner who had passed away 2 years before the first dollar went into the transaction. How do you do that? How do you present that to prospects in a community that fundamentally at the end of the day is still pretty small?
That's nuts. I mean, I guess who would have better blame but a dead person? I don't know if you
Right?
really reach. Yeah, I mean, look, you mentioned a lot of interesting points, and I wrote down a few of them. The first of which is performance is not necessarily a differentiator, and especially in this era of institutional spinoffs, when you have 8 principals coming from a super successful mega fund, well, they can theoretically all show really good performance. And so that's sort of abstracted away. So what comes next? Well, relationships, persistence, as you mentioned earlier. Then we talk about this notion of operational alpha, which is how efficient are you running your platform? Do you have operational excellence that will inevitably compound for you? So you have a team of 10. Well, how efficient are your law firm partners and your fund admin partners and your tax and your auditor? You name it. So picking the right service providers, not to plug either of ours, but it is critical. Do you see any other behaviors when it comes to hiring right or running a tight ship operationally that also differentiates a fund, or is that overblown in your opinion?
I mean, well, first, I do want to come back to one of my comments, and your comment is, yeah, obviously performance is important. Where I say performance isn't a differentiator is at a certain state, at a certain quartile or a certain category of GPs, right? I mean, again, it's table stakes that you've got to have good performance to be at the table, to be evaluated. With regards, though, to your question, I mean, again, operational alpha is important. Some of the things that we see are, how you can leverage the overall portfolio, how you can realize economies of scale, how you can standardize things that save capital or save spend. Do you need, as an emerging manager or as a fund 2 or fund 3, to have a full-time CFO or a full-time non-investing professional? Can you solve those issues through fractional solutions, fractional CTO, fractional CFO? I personally think that many groups fail miserably on the IR front. I'm biased. I was a placement agent for a little bit. I was an LP, so I understand the importance of good IR. I work very closely with a lot of IR teams. If we look at the top 20 firms that have historically been very successful fundraising, the groups that are raising, 15, $20 billion, they've had the same person in the head of IR seat for 10, 15 years. IR is IR. It's not fundraising. And people forget that. And GPs think that their experience, their track records, their resumes, their DNA is what sells the fund. In some cases, it absolutely does. But in other cases, having someone who can interact well, who can tell the story almost as effectively as you can, who can make it a comfortable environment is important. I've had clients that have hired new IR people, and I've immediately known that they were going to fail from a fundraise perspective. In fact, I remember walking into one of my partner's offices in New York and saying, look, these guys are in deep trouble because they hired the wrong person. It's like, fingers on a chalkboard every time we interact, doesn't have the relationships, doesn't have the industry knowledge. And that was the most important thing, came from a totally different sector into the private equity sector. And sure enough, they fundraised for 24 months before they got rid of this person. And, it's been kind of stagnant. And again, GPs don't think that they need to pay well in the IR world, or think that, it's something that they can promote from internally. Some cases, yeah, those promotions internally are great. I have a good friend who's currently a head of IR and COO partner at a very big fund. That fund has grown more than 10x from an AUM perspective. That GP has grown to one of the top 5 to 7 GPs in the world in the last 10 years since this person was hired. And again, it's not necessarily magic, but it's consistency. As an LP, you want the same phone call. You want to have that comfort. I think I've sidetracked from your original question. Again, down to the portfolio companies, we're hearing obviously a ton. We're seeing a ton of, the enhancements related to AI and improvements. And, again, it also depends on the strategy and the sector, right? So lower mid-market buyout companies or GPs focus on family-run businesses or mundane industrial non-technology stuff, services businesses. You can implement some very well-known software, AI, different technology improvements that have very immediate material improvements to the business. And again, one of the things that we advise our clients to do, and I think is a differentiator, is drinking from your own medicine or drinking from your own Kool-Aid, whatever the metaphor I'm ruining is. If you say you're an AI investor, use AI internally. If you say you're a software investor, use software internally. If you say you're an operational improvement focused firm, and we put this across all of our portfolio companies, show how you can do that internally and how you've done that internally.
Sure. Yeah. And one thing I wrote down here, which is especially interesting, is the definition of an IR function. From where I sit, and I've done IR in the past, and that was a 24/7 role. However, it seems as though IR is a switch that is flipped on when funds are in the market and flipped off in between raises. But you've been to, I don't know how many AGMs you've been to. You have the number, probably 1,000.
Enough to have a lot of vests and bags.
Yeah, exactly. So I'd love to borrow a few of those vests because they look great on you. But realistically, what can somebody do between fundraisers to make sure they're not losing momentum and they're not going to see attrition when they go out to the market? Because that's super important in how we see our clients using portals and the LP experience, but there's much more to it.
No, it's a great question. And again, I've always told my clients that the best time to hire an IR person is as soon as you close a fund, as soon as you're done. Investor relations is really getting to know your investors, understanding their wants, their needs, their likes, providing them the information that they need to best present you internally. Investor relations is, when done properly, will make fundraising much easier. Stay in front of your LP. I tell IR people, be in touch until they tell you enough. Communicate on a cadence, on a regularity until they say, look, we've got it. Thank you. We don't have the time, which is great. But a good IR person should have the third or fourth most knowledge of the portfolio within the GP. So, you're not the lead, you're not the senior partner, you might not be the senior associate, but you should sit in every IC meeting. You should visit every portfolio company, get to know the management companies, understand these businesses for 2 reasons. One, you want to insulate your senior partners from 80-90% of the questions that they're going to get asked. If you're doing your job right, the LP calls, you should be able to answer most of it. And, again, there are going to be some LPs who really want to talk to the senior partner. Fine. You let them talk to the senior partner. But if you can say, you know what, I can answer most of these. And, if there's something very specific you want to understand, happy to pass it on and give you, time with the GP or the senior guy. But the other piece is it just sends a great message. It shows that the firm is hiring very smart, very capable, very articulate people. And investor relations the investor relations function should make the fundraising process so smooth, right? Which GPs are going to be, or which LPs are going to be first close participants, which ones aren't going to be first close participants, which ones need certain information, which ones don't need certain information, which ones really like co-investing. So you show them the co-investments, which ones have no interest in co-investing. Which ones, I remember I was blown away. I got a baby gift from one of my GPs. And, it sounds like a small thing, but again, when you get a baby gift from someone that you're not expecting, it means something. I tell every placement agent friend, every IR person, they should have a file on every person they meet, where they live, where they went to college, what their marital situation, what their children's situation is. Every piece of personal information you can capture should be captured, should be documented, so that, when you have the next conversation, you could say, hey, how was your vacation in Greece? How's Brian? How's he liking high school? Where's he going to school? What's the thought? Again, be a partner, be a friend who likes to play golf, who likes to crochet, who likes to garden. And again, if you send an article, hey, you know what? I saw an article about this, thought you'd like to see it. It's industry related, non-industry related. Hey, you're a big fan of the Vegas Golden Knights. What did you think of the game last night? I had a conversation yesterday with a guy who, we realized my brother was the goalie on his dad's hockey team. And, again, we've been friends now for 25 years. We met in Sao Paulo at a conference. But again, it's the personal connectivity, and I will always take a phone call from it. And that's the key, right? Always being willing to pick up the phone and answer a phone call. Also, a good IR person will know when things are going sideways and be more comfortable having that conversation. I think, we haven't talked about LPACs, but the LPAC should be an ally. The LPAC should be a tool for the GP. Nothing should be a surprise to a member of the LPAC. And again, that's based on the closeness of the relationship. The IR team should know every member of the LPAC personally, should visit with them outside of the annual meeting, should understand them, so that when you get the phone call that's sharing bad news, if it's a surprise, it's softened a little bit. If it's not a surprise, it's understood better. One of the things that we're seeing in the market a lot in general are continuation vehicles, and we can talk about that. But, as a former LP, part of me is a little bit disappointed, I should say, that LPs are so negative or can be negative about CVs and citing they don't have time to make a fair evaluation or decision on whether to re-up, to sell, to roll, whatever the case may be. As a former LP, I feel for them, particularly in groups that have such huge portfolios. But also as an LP, I say, look, you know what? You've been getting quarterly reports on these companies. You've been in a position since that investment was made to track them and understand these businesses. You should have more information if that's going to be important to you to make these decisions. There are other dynamics that I totally understand and feel for the LP who is put in that position. Timing, process, volume, whatever the case may be. But from an information perspective, I think that a good IR team should provide these LPs with as much information as they can. And again, there is a tendency for GPs to hire from within and elevate from within and take, someone who is an assistant and move them up the chain. Some of those people are great. Obviously, like CAA, the big, creative arts agency, is notorious or is famous for taking people, just throwing them in the mailroom and watching them grow to become the next Ari Gold. But, the reality is that sometimes it's also a demonstration to the market that you don't take this person seriously or you don't take that role seriously. And I think it's a very important piece of the puzzle. There's a great book out there called The Tao of Fundraising that just came out, written by John Kim, who was the former head of IR at General Catalyst. Great guy, very articulate, great book for people who are interested in something to read about fundraising. It just came out within the last 3 or 4 months. But again, it's a piece of the puzzle that good firms good firms run on auto drive. Again, top 10 firms all have had stability at the senior level.
Mm-hmm. Well, I needed a good book for my flight to New York on Sunday, so I'll have to pick that up. So thank you. You
It
mentioned a
is
few really
available to listen to also.
the
You can
audiobooks
get an
are
audio.
my jam. I love a good
Yeah.
audiobook. I don't want to be all hunched up on a flight. That's not fun. We're both tall guys. You get it. As far as it's interesting, you mentioned the the interpersonal side of IR. 10 years ago, I worked in IR and public equities at an RIA. And when the market fell 5% in a given day, I knew which of my clients to call, how to deliver the message, which of them had no idea what was going on, and which of them just didn't want to talk about the market whatsoever, wanted me to ask how their dog was doing. And that was intuition. And there are systems that exist today, there's software that exists today. I'm not going to plug our platform, but it's great for that. But the reality of it is intuition mixed with good technology and good data on people. There's really no excuse for not being ahead of the game in IR right now. And you make a really good point on just not being disingenuous. If you walk into a room, be prepared. You're taking up somebody's time. They are a client of yours if they're an LP, so make good use of it. I guess just to close off, we covered a lot of ground here. LPAC, we covered your time at AGMs, we covered the fundraising environment. Anything else you wanted to add that's practical advice for a GP listening? Maybe they're an emerging manager, maybe they're a mega fund and they're just trying to get your perspective on things. What would you leave the audience with for today?
Yeah, no, it's a great question. This has been a great conversation. I appreciate you having me on the show. I think GPs over assume, again, both knowledge that the LP has, as well as their own sense of differentiation. And I think they need to realize that most LPs don't understand fundamentally what they're doing, what they're focused on. And secondly, that their backgrounds coming from Stanford, Harvard, Yale, Goldman, name the big private equity firm, isn't unique. Again, I hate to use the word table stakes, but to get to where they are, they've accomplished a lot. I tell my clients that also that the fundraising process changes every day. And if you had your college roommate, the guy who sat next to you at a desk at Goldman, the guy who sat next to you at your PE shop, be hugely successful raising a fund 3 years ago, it doesn't mean that you will be hugely successful raising a fund today. The market changes so quickly. The LP's bandwidth changes. The due diligence changes. There's so much volatility in what we do on a daily basis. You can't make any assumptions. So when you're going in, be humble, listen, don't just speak. Appreciate the fact that your background isn't different from the prior 15 GPs who came through the door that week. Appreciate that. And I tell every client this when they're out fundraising and starting to, grow premature gray and lose hair and so forth. You'll get rejected more in one day than you've been rejected in your entire life combined. Again, when you think about the resumes and the track records of these individuals, I mean, in some cases, going back to preschool selection, right? Private preschool, private high school, great universities, great job out of school, great grad school, great first job in the market. Everything is not easy, but everything is hugely successful and hugely impressive. There are a lot of LPs who, by strategy, cannot invest in a first-time fund. There are a lot of LPs that are going to wait till the final close because that is how they sell internally. There are a lot of LPs who just don't have allocation, don't have cash, don't like the strategy for whatever reason. So you're going to have to be thicker skinned than you've ever been, but in a way that's not offensive. You don't want to be aloof. You don't want to be arrogant. You don't want to present yourself as someone who doesn't care to listen. But you also do need to expect that more conversations are going to go sideways or negative than you anticipated. And, there's this funny statistic we read all the time in this industry that, the average time in the market for a fund is down to 16 months or 12 months or 18 months, whatever the number happens to be. That's from the first close to the final close. That's not the pre-marketing. That's not the build up, the ramp up to actually fundraising. So most of these fundraisers are, 24 months plus. If you're an existing GP, you announce at your annual meeting in the spring that you're going to launch your fundraise in the fall. You're out fundraising for maybe 8 or 10 months before you get to a sufficient amount of capital to have that first close. Your LPA, your limited partnership agreement, says that, from the first close, now you have either 18 months, 12 months, or in some cases, 24 months to get to that final close without, LPAC or investor approval to extend it. And, so it's a marathon. It's not a sprint. And again, going back to people who may have said no earlier, in some cases makes sense. Keeping a good, robust database of the communications. Let's keep in touch. If you say, let's keep in touch, keep in touch. If there's an LP that is a last close LP and they tell you they're a last close LP, give them a few months of a notice when that final close is going to happen. Let them know that the allocations are starting to shrink. Again, in some cases, tell more of a story than's reality. Hey, you know what? We're down to the last $100 million. If you want in, this is your shot. Understand what carrots you need to give to certain LPs. We didn't talk about, first close incentives. It could be the first look at the co-invest. It could be reduced management fees. It could be, different dynamics like that. Think about what's important. Think about what you're willing to give up. And also, I'm sorry for rambling a little bit. One of the things that, LPs really think about is when a GP is having a hard time coming up with their own allocation, their own GP commitment. So, 1%, 2% of the fund size is what's considered standard. 2% is actually considered standard to show you've got skin in the game. If you're in the market saying you can't afford 2%, it's a little paradoxical to having told them that you've been an incredible investor for the last 10 years, 15 years. If you need to go out and find a seeding platform to put the capital in your bank account to help you build your entity, it also sends kind of a mixed message. So think about that messaging. Think about how an LP is going to view you if you've only spent 3 years at your prior firm, you're a partner, and then you've decided you're leaving to move on. You're leaving a lot of other LPs kind of in the lurch because they wrote a commitment assuming you're going to be there for 10 years. So, a long answer to a very short question, but I guess to summarize is think about, how the other side is going to perceive you and act appropriately. And, again, thick skin and marathon runner. Know that it's going to take a while and be patient and keep your family and your children and your partners and your spouses and anyone who interacts with you informed. Let them know that it's taking a toll on you. Don't, be surprised when people are wondering why your mood is different than it's been your entire life. Be honest with yourself, be honest with everyone around you. And again, LPs will see that. LPs will see your behavior. LPs will like you more, I think, if you're open and honest and sharing some of this. Yeah, God, it's great to see you again. It's been a slog. Yeah, we haven't talked in 12 months. Still here, making great progress. Made some great investments, great pipeline. Would love your partnership.
There's something to be said about authenticity. I think a lot of us lose it. I mean, everybody has bad days. I have bad days. You have bad days. And it's worth calling that out. And having a good support system and good hobbies outside of the office. Brian, we could talk for 10 hours. We only had one, but definitely have you back on the show. I hope to see you again soon in San Francisco or down here in LA. And we appreciate the time, my friend.
Derek, thanks so much. Have a great weekend and anytime. Looking forward to chatting again soon.